But there's one very key lesson that I took from 2021 that I'm going to share with you today, and that is if you guys are new here, my name is Daniel, and here on this channel we talk about stock market investing, especially investing in the Canadian markets. Hit that subscribe button down below because this year I'm bringing you content every single week about my TFSA portfolio, so you don't have to read in between the lines as to what I'm doing with my money and if I'm telling you the truth, because I'm just showing you exactly what I'm doing, so that should speak for itself. And because this is a Monday video, I'm going to show you guys what I invested in the past week as well as what I'm buying in the week to come. But I think first off, reflecting on 2021 and all the craziness that went on in the market. Like, you remember GameStop at the beginning of the year. Then we had all these small cap stocks peak, and then all of a sudden they crashed like 60, 70, 80, or even 90%. And then I think a lot of people were left scratching their heads as to what happened to their favorite growth name stocks. And nearing the end of the year, we've got the big cap tech stocks like Apple, Microsoft, Amazon, and Google making new all-time highs and still continuing that till 2022. With all this action happening in 2021, maybe in 2022 we'll have just as an exciting market to try to make some money in it. But there's one very key lesson that I took from 2021 that I'm going to share with you today. It's that there's many players in the market, and for me as a long-term investor, I made a few mistakes. So looking back in 2021, a lot of the stock analysis that I did was actually comparing companies against their competitors, and as long as they match 1-to-1, then they're fairly valued. But I saw there was value if one stock, for example, had a higher PS ratio than the other one. The one that's got a lower PS ratio must be slightly undervalued if their business is pretty much the same. But the one that I forgot is the fact that looking at one versus the other, maybe both of them are actually overvalued. However, the reason they're overvalued is because they're short-term traders. So there's short-term traders who are just in the general market trying to make a quick buck in a year, for example. Those guys might be propping up both the stocks just as much, so their PS ratios are equal. Then there's day traders who push up stock A a little bit further than stock B. And because there's momentum in stock A, everyone is thinking stock A must be better. However, that's not always the case. It's the short-term traders and the day traders, they don't really care where the stock goes long-term. They're only in it for maybe a week or even a day. So that's why some stocks really get pushed very high and all of a sudden they come crashing down. And when they start coming crashing down, maybe everyone else questions their investment in stock B as well in the entire sector. So everything just sells off. And I think that's what we saw at the end of 2021 as well as going into 2022 with all these small caps getting slammed. It's all these short-term traders as well as swing traders who are just getting out of the market, and it's the long-term investors who are left bag holding. However, as a long-term investor, I don't subscribe to the game of just selling off because everyone else is selling. I still think that the companies that I'm invested in, at least a good amount of them, could do better in the future. Obviously, my prediction is not guaranteed. However, I'm keeping my money invested because I do have a hope and think that the company will do better 5, 10, or even 20 years down the road from now. But as long as the products that those companies build, people need them, then they're going to continue to grow. And most of the companies that I'm investing in are companies that have new technology solutions that make it a lot cheaper to do the same thing versus their large cap counterparts. And when looking at my portfolio right now, sometimes it's very painful because I see thousands of dollars in the red right now, so it'd really help me if you hit that like button right now. So you'll see in my portfolio later on some stocks like D2L or Good Nature Products or even Well Health Technologies. These are relatively newer companies bringing a product or service that's innovating on what's been done in the past. And all three of these stocks have gotten hammered. However, there are some long-term trends that I think should be playing out well for them, which is why I continue to buy and hold into these stocks. I honestly don't know where they're going to go in the short term, so if that's your time horizon, maybe you want to stay out. But for me as a long-term investor, my time horizon is at least 3 years for this portfolio challenge and probably going to hold these till retirement. So with that said, let's jump over to my computer and take a look at my portfolio. So this past week was an interesting week because I did quite a few different purchases. So first off, depositing cash on the 4th, I ended up buying some D2L stock. As usual, I bought 2 shares worth $13.60 a piece. Then I got a dividend from TELUS, a nice juicy $5.89. Following that, on the same day on the 4th, we bought some Nuvei. I bought a fractional share, about $30 worth. Then I did 2 purchases of Shopify, one on the 4th and one on the 6th. I bought $50 worth and $25 worth as it continued to come down, and today I think it's sitting around the $1,400 to $1,500 level. Then I also bought a fractional share of National Bank of Canada, deposited about $30 into that one. Then we also bought some Air Canada, 2 shares for $22.74. And to cap off the week, this is a new stock here. I bought Meta Platforms, but on the Neo exchange, and I paid $19.48 per share. So instead of buying Meta in USD, basically on the Canadian account, and losing out on that 1.5% exchange rate, or it might be a little higher than that, I decided to buy the Neo version, which is essentially fractional shares. If you're interested in learning more about CDRs and how I bought Meta Platforms for about $20 Canadian, not USD, you should check out my video in the top right corner. Other companies you can buy through CDRs are like Amazon, Apple, Google, Costco, or even Visa. Every single week I like to take a look at my portfolio metrics and just see where the portfolio is at. I mean, it doesn't change my investing style, but it's just a way that I keep tabs on it. So currently my portfolio is down by 0.6% ever since I started this, and I'm down $63.17. And remember how I was talking about there's different players in the stock market, and sometimes there's more long-term investors, sometimes more short-term investors, and this can actually vary by sector. So right now it seems like a lot of money is flowing into big tech as well as safer play stocks like banks or telecom. And the TSX right now is up by 11.12% since I started this portfolio. And the majority of the TSX is made up by like energy companies, resource companies, as well as financial companies. So this is where it looks like a lot of the money has been pouring ever since March 16th. And my portfolio is a little bit more risky. I've got some technology stocks in there. I've got Bitcoin. As you can see right here, my breakdown. 21% in tech. And looking at the risk, I've got about 16.6% in high risk and 46.3% in medium. And these are like smaller cap companies which have been hammered. And 37.1% in low risk, and these are your larger cap stocks. So the low risk portion of my portfolio is probably doing better, and we can actually check that over here. Right now I've organized my portfolio by risk level, and all the low risk stocks are up pretty much in line with the TSX. So right here you can see the TSX is up by 11%, and these stocks are all up by 11 to 19%. Then we've got our medium risk stocks, which are these stocks over here. So these stocks are kind of all over the place. Some are down by 21% like Enchos, some are up by 10%, so it's kind of a wild card. And the same goes with all the high risk stocks here. Well Health Technologies down by 31%, Good Nature Products down by 34%, so these have even crazier swings. And if you got money in cash right now sitting in your bank account in one of the big 6 banks, that's a big mistake. Once I heard about EQ Bank and their interest rates, which are anywhere from 25 to 125 times higher than the big 6 banks, I immediately switched my emergency fund into EQ Bank, and they pay about a 1.25% interest as of releasing this video today. So links in the description down below. Now wrapping up with what I'm going to be buying next week. Right now I really like Shopify because this is a stock I think long term will do very well. The whole world is going towards e-commerce, and I think a lot of businesses like the personalized touch that Shopify gives them to be able to brand their stores on a website, and it's super easy to set up. Right now at around $1,500 per piece, it is quite below my cost basis per share. I know Shopify is very expensive traditionally as a stock. That's why I'm dollar cost averaging into the stock. And I think that there's a lot of short-term traders getting out right now, so the price may plummet a bit more. I'm also going to continue to bolster my position in National Bank because it's a very small position, so I'll continue to dollar cost average into that one. As well as Nuvei, this is a stock that got hammered by short reports recently. So at these prices right now, it might trade flat for a while, but hopefully it will end up picking up just because the business actually is profitable and they're continuing to grow. And this is actually very unheard of for a stock in this category, for a size of this company too. Because we got other companies out there like Lightspeed, which is our competitor, which is still unprofitable. But the fact that Nuvei actually cracks out a profit, this is why I'm building up this position in this portfolio. Enchos has been coming down like a rocket at $44 per share, so I'll be adding more to that stock as well. And if you don't remember me talking about Enchos in the past, this is a stock that I'm going to continue buying just because they're a company who acquires other companies. And I think through the past year or two, acquiring other companies was very expensive because the stock market was expensive. But now that all these small caps are going down, Enchos is actually going out there acquiring like micro cap stocks or small cap stocks or even private companies, which are very small. Their premium is coming down, so Enchos should be making more acquisitions going forwards. And acquisitions is basically the bread and butter of Enchos. They have a great way of finding value and paying a fair price for it, and integrating the new business with their current business and supercharging the entire corporation. So that's all for today's video. If you guys enjoy this video, leave a like down below, as well as I've got a couple videos up here on the screen that you might be interested in. So check them out. If you're there, I'll see you there. If not, keep up the grind and have a great day.